So today we're going to be talking about internal range liquidity. Okay, we're going to be talking about internal range liquidity. Let me just put that down. Internal and external range liquidity. So this is a very, very important topic. Okay, it's a very, very important topic when it comes to trading and reading the charts or doing technical analysis. This is very, very important. So you have to pay attention, make sure that you follow this lesson right up to the end. Now, we understand that the market is being moved by money, right? The market is being moved by money along the market or along the chart. So these candles that we see every day, it's simply just telling us a graphical is a representation of money that's circulating in this market. All right, so every candle here has a story to tell. Like if you see a big bearish candle like this one, it has a particular story it's telling you, all right, which means there is selling volume in the market. Some people say supply is more than demand and so many other things, right? So the markets are simply just giving us information, and this information is based on what we call liquidity. Liquidity is simply the money that is actually circulating in the market, all right? So now when you notice where money is sitting now in the market, that's definitely where you will now say, okay, this is where liquidity is, because that's where you as a trader, you kept your money in, right? Now there are so many key areas in the market where we have liquidity, all right? So this is going to be very practical. I'm going to be showing more examples than just theory, because I think I've done a lot of theories about this internal range liquidity to external range liquidity and all those things. Now we are talking about internal and external. Just from the terms, external here simply means we have something that is on the outside, right? We have liquidity that is on the outside. It's on the outside of a range. That's why the range term is coming from. This is our range high, and this is our range low. So this is in between the range, and therefore means anything outside here is called external range liquidity. Now you ask yourself, what can be outside these particular areas? What can be outside here? If you are a trader and the market turns at this point, what type of liquidity will be sitting here, or how would we say that there's liquidity here? Now you will notice that the traders that are going in on a buy trade here, they are putting their stop losses below that swing low, which means that if the market comes back to hit those stop losses, that's actually where their money gets to either leave the account or come to the account if that was your take profit at that zone, right? So which means that the order that you place in here, if you place a buy order here and the market is still moving around this point, now you are floating in profit. That's why they say you are floating in profits, not that the money is already neither in your account or wherever. Because if the market eventually comes back and hits your stop loss, meanwhile you were risking $100, then despite the profits that you had, you have actually lost $100, right? So which means that the $100 risk that you are putting here, and you are putting that risk with a stop loss figure, that's actually where your main order is, right? That's actually where your main order is. That's where the main liquidity is, because it is on that stop loss where if price hits it, that's when money is going to leave your account, right? Now, the market can play around here for a couple of days, but the moment it comes down to liquidate your order, that's when your order is going to be closed and money that deducted from your account or added if that it was your TP or stop loss in any of the ways, right? So this simply explains that whatever you have above a swing high or below a swing low is called external range liquidity. I'm not going to talk much about that, just make definitions like that. But now you understand that you have stop losses here, right? And there are other traders who are saying to themselves that if the market wants to continue higher, then if it breaks this high, it means it wants to move higher. It wants to continue higher. Therefore, what they do is they place buy stops at that point. They place buy stops here so that when the market takes those buy stops, when it activate that buy stop figure, it turns now to a buy position. And if the market is going up, they are in profits. And if it wants to come down, maybe they place their stop loss somewhere here. And then if the market is coming back to hit that stop loss, then their position is liquidated, right? But if it doesn't, and it's going up there in profit till they close it maybe at the nearest swing high, right? Now, we understand that we have stop losses sitting above and below swing highs, because traders, right? People will be buying here and putting their stop losses here. People will be selling here and putting their stop losses here in every direction. Now, all these orders that are being placed externally, they are called external range liquidity. Okay, swing highs and swing lows. Now, when we talk about all these orders that are being placed at the highs and lows, now how does it interest the market, or how does that actually concerns the market, right? Now, I'll explain this to you in a very clear way. Like I used to say, that if you have something that you want to sell, all right, if you have something that you want to sell, you definitely need someone that is going to buy that, right? You definitely need someone that is going to buy what you're selling. So if you have something to sell and nobody's buying, therefore you won't be making there won't be any transaction or any business. Now, it is the same. We understand that the institutions are actually the ones that are doing what? They are the ones influencing price movement, right? They're the ones that are influencing the movement of price. So this means that if they really want to buy a quantity of euro, if they want to buy a quantity of euro, what they have to do is they need buyers, or they need sellers. They need people to sell to them, right? Before they can be able to buy. Now, let me explain something here that many of you don't really know. Now, when you place, let's say you enter a sell position here, right? And you place your stop loss here. Now, this stop loss that you are placing here is actually a buy order. All right, it's actually a buy order. Take note of that. It's actually what? A buy order that you're placing against the sell position that you had. All right, now this means that, okay, you had some stuff that you were selling, right? And then the market wasn't going down. All right, then you buy back what you were selling. Or let me put it in a sell direction. I think it will be much better. Let's say, for example, you place a buy order here. You place your buy order at this point, right? You place your buy order somewhere here, and then you have a stop loss below this swing low. Now, your stop loss that is below this swing low is a buy order. Okay, it's going to be a sell order. You are selling what you bought, right? I don't know if you guys understand that. That's why when you see Trading View, that's why on Trading View, you're going to see something that is like this. Let me just quickly show you guys an example of something very interesting. Now, if, for example, I want to place a buy order here, okay? I want to place a buy order here. Now, if I click buy, you're going to see that I have a buy position. You can see the arrow. Now, if the market moves up, for me to close this position, all right? For me to close this position, I have to sell what I bought, all right? I have to sell what I bought now at a higher price so that I can be able to make profit, okay? So if I bought something this low, and if it goes higher to a certain level, if I'm selling that position now, if I'm selling the quantity of what I bought, that's how I'm going to make profit, okay? But now, if I buy at this point, and then it goes down and I sell, since I was buying, it goes down instead and I sell. What just happened is that I bought something at a higher price and I sold it at a cheaper price. Okay, so I've made a loss instead because I bought it higher but sold it cheaper, right? So this simply means that, for me now to close this position, I will have to sell. All right, I click on the sell and then it closes the position. Now, what am I trying to say here is that when the institutions want to do what? When they want to buy, right? Listen very carefully. When they want to buy something, let me just quickly look for an example. Good. We have a clear example here. Now, let's say that this is an example, all right? We have marked out a key level here. We suppose it to be another block, right? Now, we have that key level there, and what are we trying to do? We are waiting for price to come down to this key level so that we can place our buy order, and then we have our stop loss below this low. Now, the buy order that we are placing, here is a pending order, right? So if the market comes here, we buy, all right? But now, if it comes down to this point, where is our stop loss, right? Which is external range liquidity. What is going to happen? We are going to sell what we bought at a cheaper price to the people that want to buy, which is what? The institutions. Because I said, if they want to buy, what they simply have to do is, they want people to sell to them, right? So now, if price comes here, and then what happens? They're going to push it down to a point where you have to sell out your position to them before they drive price to the upside. I don't know if you guys actually understand what I'm trying to say. Now, take note. They want to buy, and you want to buy, right? So everybody's buying. We all see that it's an uptrend, so everybody wants to buy. Now, who is selling? The person that is supposed to, when you place your stop loss here, it is a sell order that you are placing, which means that I bought something at 5. I bought this at 5, and if it is going down to 2, then I'm selling it. So which means that if you bought, let's just say this is a chart of Apple, right? Or let's just say iPhone. Now you bought 10 iPhones here at 500,000 each. 500,000 each. You bought 5 of them, right? Now you bought 5 of them, 500,000 each. So this is 500,000 level, right? And now below here is 200,000 level. Now what happens is you bought here at 500,000, and now what happened? The prices of the iPhone is dropping. It drops to 200,000. Now what you as a trader wants to do is, I want to sell off those iPhones at 200,000. Now if you sell them off, remember you bought 5 of them at 500k each, but now you are selling them off at 200,000. You bought at 500, but you are selling them off now at 200. That's the meaning of your stop loss. Okay, that's the meaning of your stop loss. Now you are selling it off at 200,000 to the people, to the institutions, or to the big guys, or to the smart money traders, right? Those who understand that they have to buy at a lower price. Okay, now this simply means that I'm just giving these examples to illustrate what I say. The market is all booked by liquidity. If there are no buyers, there will be no sellers. And I'm trying to explain to you the type of liquidity that is sitting below swing lows and swing highs. Just like, for example, this one. The liquidity that is sitting here is your sell orders, right? When you buy here, you place your stop loss here, and that stop loss is a sell order. Okay, so which means that if the market comes down, let's just say the market comes down. Now, the market is going to come to this point, to our entry, and what I'm going to do is place a buy order. Okay, I'm going to place a buy order at that point. And now, if I place that buy order and the market doesn't go up and it keeps going down, what is going to happen is that what I bought is, the prices are not instead increasing, the prices are instead reducing, right? So I'm instead on a loss. You understand? I'm instead losing. The value of what I bought is instead decreasing. Now I've placed a buy order. Okay, this is, I think you can see where I'm placing the orders right down here. This is the sell, and then this is the buy. Now let's see, I bought this. All right, I bought this. Now my stop loss is going to be below this low. Okay, my stop loss is going to be below that low. Let me put it. This is my stop loss, below that low, like that. All right, now that's my stop loss below that low, and my TP, let's just say my TP is above that high. Okay, now this is what is happening. Take note of that. If the market comes down to hit my stop loss, I'm going to be losing $4, right? $4. Now this means that I bought something higher and the value of it has decreased by 4, and I want to sell it off, right? So the type of liquidity that is sitting below this swing low is the sell side liquidity, and it simply means I am selling off what I bought at a cheaper price. That's why we will tell you that the market is always looking for liquidity. So if the institutions are now, my stop loss has been hit, right? So what I bought now for institutions, this is where they get in. Once the liquidity has been cleared, that's where they are coming in to buy. All right, I think that explanation is quite clear now. So let's move again to our main topic for today: internal range liquidity to external range liquidity. I wanted to bring your mind to understand the types of liquidities that are present, right, and where and which one is this one, and so on. Now, for you to actually understand internal range liquidity to external range liquidity, when it comes to external range liquidity, we are talking about what? We are talking about highs and lows. All right, they can be equal highs and equal lows. These are areas that people are putting their stop losses. Take note. These are areas that people are doing what? They are putting their stop losses on swing highs and swing lows, just like this one that I did here. Right, so people are putting their stop losses on these swing lows and so on. So that's where we have external range liquidity. Now we also have what? Internal range liquidity. Now with this internal range liquidity, we are talking about what? Order blocks. We are talking about fair value gaps. We're talking about volume gaps, and we're talking about breaker blocks. Okay, also mitigation blocks and so on. Now all this information here are most internal range liquidity, right? Internal range liquidity areas, or PDRs, or whatever you want to call it. Now where do we see this one? Remember we mentioned that the market has just two movements. Okay, the market has just two movements. It's either the market is doing what? It's either the market makes an impulsive move or it makes a pullback. If it makes an impulsive move and the pullback is the same, there is no big deal. The market will either buy or sell. You either buy or sell. It is that simple. But now when we have an uptrend like this, the market creates a swing low, creates a swing high. This is external, this is external. Now what we have inside this range is now what we call internal range liquidity. And like we mentioned, that the market always moves from liquidity to liquidity. What happens is that when the market grabs this internal range liquidity here, right, whether it's a fair value gap or so on, if you didn't follow the lessons of fair value gap, you can go to my YouTube and then you check that. All right, you just go to the YouTube profile, you check, you'll see lots of videos on fair value gaps. Now once price comes back and does what? Balance that fair value gap here. All right, what next? It has filled up the liquidity that was here, or maybe it was an order block that price was coming back to mitigate the positions that were there. Now once that happened, what happens? We have external range liquidity here. We have people that were selling, and what happens? The market needs to come to them so that they can buy off their positions now in a loss. It's just like you sold something. I mean, you sold something at a cheaper price and you are instead buying it expensive. It's just like it's just like you bring your phone to me, you say, okay, I'm selling this phone for 500,000, and then I buy it for 500,000, and I'm selling it back to you at 700,000. You understand now, right? So you are making a loss, all right? And I just made again. So that's what is happening. So the market will come back what? To this external range liquidity. Since you sold, the market needs people that are buying. So it will constantly be coming up to that people, so that coming up to activate the buy orders of people. All right. And once that happens, it does what? It has grabbed external, so it needs to come back to internal. Probably might have an order block here. All right. I've made lots of lessons about order blocks. You study them, and then what happens? Prices come back to mitigate the orders that were placed on that order block. And then what happened? I'm not talking about gaps now, please. You should watch a lesson that I've made. You should be on Telegram or you go to YouTube. Now, what happens is price is coming back to mitigate that order block, which is what? Internal range liquidity. Remember I said it's within the price range, is within this displacement leg. Okay. Now, once that happens, external range liquidity has been built here and the market has to go back for it. Now, let's talk about this one. What actually happened here? Why would price create a high, come down, go up again, then come down to take that high, and then still want to continue higher? Why should that happen? All right, because I think that's the question you have been asking yourself. Why should that happen? Why should the market be on an uptrend and then it takes a low to still continue higher? Right? Now, this price taking a low to still continue higher, it's the exact same thing that I explained in that what? The institutions, they cannot just keep buying without people selling to them. So what happened here is I just sold out my position to the institutions and they bought it. a lot of other people are already also doing the same thing. They sold out their positions here as their stop losses, right? Institutions bought it and price is going up. It's the same thing here. They sold out. The people that had their stop losses below this window, what happened? Price came down. They sold out those their positions, and the institutions bought what they sold, and the market went up. So it will keep going up, but now it reaches a certain point where everybody now wants to buy. So what happens? The market needs you to sell off your position. So you always create stuff like this. But now, technically, what is actually happening here is that price is filling a higher time frame liquidity area. Okay, price is filling a higher time frame zone. Now, this brings me to the point where I will say that your internal to external range liquidity, you should determine them on the higher time frame. It's not on the lower time frame. Okay, you determine your internal to external range liquidities on the higher time frame. I'm going to just give you a very quick example here. Let's just look for an example which is very, very easy, like maybe this one here. Let's just look at this one. Something like this. Now, what happened here? We simply had price went up, came back down to rebalance a fair value gap, or this imbalance here. Okay. Now, this imbalance is in the form of what? Internal range liquidity. Okay. This fair value gap is in the form of internal range liquidity. So the market took out external range liquidity, gave a pullback to fill internal range liquidity, and then you went back up again to do what? Grab external range liquidity, and it has created another fair value gap again, which is likely going to come back to rebalance that fair value gap, and the cycle continues like that. Okay, the cycle of the market, it continues like that. Now, I want us to study this internal range liquidity, what price did here on the lower time frame. Remember, I said you determine your internal and external range liquidities on the higher time frame. All right, and then as you drop to the lower time frame, now you study what is actually going to happen. Now look at this one. This was also our internal range liquidity fair value gap. You can see our price came back, fill it, and then went up. Now we have also filled this internal range liquidity, and price is rejecting to go up. Now what we are going to do here is we are simply going to go to the lower time frame, and then we'll see what is going to happen there. All right, now I'm going to quickly draw something so that as we go to the lower time frame, you're going to see it as well. Look at this. We have a swing high. Price comes with internal range liquidity. Another swing high like that and like this. Now, this is a daily chart, right? This is a daily movement. What is happening here is price is coming to fill fair value gap like this one and like this one. Another fair value gap filled. Now, what we are going to see on the lower time frame is this. What we'll see on the lower time frame is price creates a high, creates a low, creates a high. Okay, this is for this one. And then now we have a low, and something like this. Price takes out a low here. It continues higher like that. Then it comes down, takes out another low, goes up, comes back, take a low like that. Okay, now what is happening here? This low that is being taken out here, there are people that are selling off their positions here. Stop losses, right? Now, why is that happening? Why did price break this structure? Because price is coming back to fill a fair value gap on the higher time frame. That's why I said you identify your areas, you identify your internal to external on the higher time frame. Now, when you go down to the lower time frame, you understand that the market is pulling back just to fill a fair value gap, not actually reversing. Because when this happens, a lot of traders will start to say that, okay, the market should keep going down. We are now having a break of structure to continue to the downside. Let's look at an example here. Let's study these two areas. Okay, we have two fair value gaps, which is our internal range liquidity, right? Let me see if price went back here. Okay, let's study what is happening here now on the lower time frame. Okay, put that a little bit faster so that it expands, and then we'll see. Now we're going to, this is the daily chart. Take note of that. This is the daily chart. We spotted our internal range liquidity on the daily chart. So what we're going to do is go down now to a lower time frame and see what actually happened when price came back to fill all these gaps, right? You can see how we fill this one, and then price is pushing back to the upside. Now let's go to, let's say 30 minutes. Let's go to 30 minutes. Good. Very good. Very good. Now, study this area very well. Okay. when you look at this price point, when you notice that the market was coming back to fill that gap, which was this point, this was where price came back to fill the internal range liquidity. Take note for the first fair value gap. Now you are going to notice that something happened. The market broke structure to the downside. Not maybe just once, probably like 2 times. Okay, 2 times. Now, what I am going to be thinking is the market is now supposed to be going down. We should look for sales. If you are not aware of what is happening on the higher time frame, you are going to be messed up right here. Okay, because you will start looking for sales against what the overall internal to external range liquidity is doing on the higher time frame, or they call it institutional order flow. All right, the IOF. Now, if you don't understand what the IOF is showing on the daily or on the higher time frame, you'll be confused on what to expect on the lower time frame. Rather, someone that has looked at the higher time frame, he will wait for price to come into the internal range liquidity and shift structure back to the upside so that he can now place his buy position. Why? Because first and foremost, you know that you are not supposed to be buying in the downtrend, and therefore this was actually a downtrend that was happening here. Now, when will this downtrend be end? When price fills the internal range liquidity and start to break structure to the upside, we now confirm that the downtrend has ended, right? Now let's study the second fair value gap. This was the second internal range liquidity that we saw on the daily, all right? Now you look here as well, you notice that price shifted to the downside. Couple of lows, breaking couple of lows to fill that fair value gap. Now, does that mean we are now in a downtrend? No, we are not yet in a downtrend because the higher time frame is still bullish. Price is still moving to the upside. Price was simply just coming back to fill internal range liquidity, and then we saw lows that were taken out on the lower time frame. Okay, so you have to understand your higher time frame narrative first before you start looking at the lower time frame, so that you will not be trapped buying when the higher time frame is now going for internal range liquidity. Okay, I have to understand the market will either be doing 2 things: going for external, coming back for internal, and then going for external. Once it grabs external, you have to be very careful. Understand whether the market phase that we currently have now, is it coming for internal or is going for external? Once it grabs internal range liquidity, probably a fair value gap or other block, and then it starts to reverse, you now know that, okay, the current phase we're having now is price is going for external range liquidity, and therefore the market is going to be moving to the upside. All right, so now on the lower time frame, you will be able to understand the bullish structure that you are having. But when price is pulling down to internal range liquidity, you're going to notice that you have a downtrend. It is normal. You just have to understand that this downtrend is not going to end because it is just a pullback on the higher time frame for price coming to grab internal range liquidity. Okay, so that's simply the concept of internal to external range liquidity. The market moves from internal to external, external back to internal, internal to external, external back to internal, vice versa. That's how the market books. You will go for external, come back for internal, go for external, just like that all the time. All right, so I think I've explained a lot. I didn't want to make the video long because I think probably a lot of people will want to watch it as well. So if you have questions, we're going to host another session tomorrow, and one of our students, we're going to be talking about time and price. Okay, you don't have to miss that one. So that will be a great lesson for you too. Okay, don't miss it. All right, so I think that will be all for today. We're going to have another session for question and answer so that you can ask your questions.